Good morning, all of you. In previous video, we discussed about that modified accelerated cost recovery systems, in which there are two systems: alternative depreciation system and the general depreciation system (ADS and GDS). So we discuss about that, and we go through this uh, property classes. We go through the property classes, number of that property classes, ADS class life, GDS class life. Again, for that particular uh, class life, for that particular class life, these are the rates. These are the rates that we apply for the first year, second year, third year, fourth year for calculation of the depreciation. So this is the third table in which there are methods are given for property having a period 4 year to 10 year. Which method you should use? From 10 to 16 year, which method you should use? So these are given in these three tables. So numericals based on these three tables, we go through this some numericals like this. So these tables are given. This numerical is given here. So this numerical is based on that particular modified accelerated cost recovery system. So here, this example given is a firm A bought a piece of equipment 6 years ago for rupees 18 lakh or rupees 18 lakh. The equipment is expected to be operational for 20 more years. If the class life is the 12 years, what property class does the equipment belong to under the modified accelerated cost recovery system (MACRS) in GD system? In GD system, what is the depreciation charge for the equipment 5 years after its purchase by that firm? Also find the book value at the end of the 5th year if the equipment is disposed of. So here in this example, that cost basis value is given this much. Cost basis value is given this much, and they asked to find out its time period for which we can use it is 20 years, which we can use for 20 years. But this equipment comes under the class life of 10 years. Class life of 10 years. In first table, 12 years. For 12 years, in that class, this equipment is placed. In that class, this equipment is placed. And again, so what is the depreciation charge for the equipment 5 years after its purchase by the firm, and end of the 5th year if the equipment is disposed of. And suppose that depreciation, they ask to find out depreciation charge for the equipment 5 years after its purchase. After its purchase, what will be the depreciation after 5 years of its purchase? And if that equipment is disposed of, at the end of this 5th year, then how much will be the book value? So as we already go through that, we consider if that equipment or that machinery is disposed of before its life. In that case we consider only half of that value, of depreciation, So here we consider that particular concept. So here now, cost basis value. Now what are the given quantities are written here? Cost basis value is a 18 lakh. Cost basis value is given as a 18 lakh. Class life according to table is given as a 12 years. According to table it is given 12 years. Service life 20 years. Service life is 20 years, but according to class life, that class life is a 12 years. So from table number 3, for class life 12 years, from table number 3, for class life 12 years, the corresponding GD's period is 7 year property. From table number 3, for class life of that 12 years, the corresponding GD's recovery period. So if you go through this third table, if you go to the third table, class life is in between this 12 years, 10 to 16, that comes under this rule. 10 to, or this lot, 10 year to less than 16, 12 year. So this GDS year, this GDS class life year you can use 7 year. GDS class life year is used as 7 year. So this is used here. This is used here. So depreciation class life 10 year. For this depreciation class life 10 year, the corresponding GDS recovery period is given as a 7 year. Recovery period is given as a 7 year. Now, for this, now ADS life is given as a 10 year. ADS life is given as a 12 year. GDS life from table we find out that it is a 7 year. So from table number first, so if you go through this table number first, ADS class life value is given as a 12 year and GDS class life value is given as 7 year. So that property comes under this line, under this class, having ADS value is 12 year, GDS value is 7 year. So that come under this class. So it is a manufacturer of motor vehicle class, and it has number 20.1. It has number 20.1. Now so it is a given here. It is under class of 20.1. And now the percentage depreciation for 7 year property. Again, if you refer this table number 2, you will find that for 7 year property, depreciation percentage for 7 year property here. Depreciation percentage for 7 year property. What are the rates we consider for depreciation calculation? What are the rates we consider for depreciation calculations are given. For first year it is a 14.29%. Second year it is given as a 24.49%. Third year it is given as 17.49%. Fourth year it is given as a 12.49%. Fifth year it is given as a 8.93%. Sixth year 8.92%. 8.93%. 8. 4.46. So these are given from table number 2, and to calculation the depreciation we use that rates calculation, or that factors are used for calculation of the depreciation. So if you look at here, so this is a cost basis value. Now this BTCF it means before tax cash flow. This BTCF it means before tax cash flow. So these are the nothing but all the depreciation we calculated before tax paying. So all the depreciation we consider in terms of expenses, or it is a loss. It is a loss to the firm's income. So it is come under the loss. So from that profit, this much term or this much of value we subtract, and then whatever that amount remaining, on that remaining amount we pay some tax, income tax. So this is a value which is a before tax cash flow. These are the values of the before tax cash flow values. So this is a BTC, before tax cash flow values. So this is value is given as a 18 lakh. So it is written as 18 lakh rupees. Now depreciation amount. So as it is purchased, that time is a zero. After 1 year. So with that rate, after 1 year, with that rate, which is given in the table number 2, 0.1429. So 14.29%. So it will comes as a 0.1429 for calculation purpose, 0.1429 like that. For second year it is a 24.49%. So it is 0.2449. Such that with that table and given rate, you find out the depreciation value here for first year, second year, third year, fourth and fifth year. So ask here for the fifth year values. They asked for depreciation charge for the equipment for fifth year. after its purchase. So we calculated up to 5th year. We calculated year up to the 5th year. So further calculation we not record. Further calculation we not record. So we stop at the 5th year. We stop at the 5th year because they ask for the depreciation value for 5th year. We stop at the 5th year. So summation of all this comes as a this much. This comes as a this much. The 13,98,420 rupees. So summation of all this comes like this. So this is the total depreciation. Total depreciation is this much. For first year depreciation this, for second year depreciation this, third year depreciation this, fourth year, fifth year like this. And now book value. Now book value for the fourth year. Book value for the fourth year. So this equipment is disposed of. This equipment is disposed of at the end of the 5th year. At the end of the 5th year, if the equipment is disposed of. So this is considered book value for year 4. So we are interested to find out the book value at year 4. So this book value we have to find at the end of the 5th year. But this equipment is disposed of before its useful life. Before its useful life. So this equipment is disposed of at 5th year. Before its useful life 12 years. So we consider that depreciation value of that equipment used at middle of that 5th year. At the middle of the 5th year. So to calculate book value at the end of the 5th year, we should consider this book value of the 4th year. Book value of the 4th year minus this depreciation value. In the 5 years, minus depreciation value in that 5 years. So that whatever that remaining quantity is nothing but the asking quantity or book value at the end of the 5th year. At the end of the 5th year. After the 5 years. At the end of the 5 years. So this depreciation value, so book value at year 4, that will be calculated like cost basis value minus depreciation amount for the 4 year. Depreciation amount for the 4 year. Depreciation amount for the 4 year, here it is a summation of this 4 year. Summation of 4 year. This 2,57,000, 4,40,000, 3,14,000 and 2,24,000. Summation of this 4 quantity is nothing but the depreciation amount for the 4th year for 4 years. So that much comes as a this much 12,37,680. So for 4 year summation is the depreciation value for the 4 year, that is subtracted from the cost basis value 18 lakh. So whatever that remaining is the book value for the 4th year. Book value for the 4th year. Now for depreciation deduction in year 5 can only consider as a 0.5. So only half depreciation deduction we consider, as it is disposed of before its useful life. So we consider only half of the depreciation. So that depreciation is considered as a 18 lakh into 0.0893 for 5th year into 0.5. Half of this only we consider. So into 0.5. So half of this only we consider. Fifth year depreciation according to table it comes as like this 16 lakh rupees. But according to as it is disposed of before its useful life, we consider as a 0.5 of this much amount. So it comes as a 80,000. So this comes as a 80,000. It is a 1 lakh. It is 1,60,000. So it is comes as a 80,370. As we consider half of this. So now to find out the book value at the end of the 5th year, so book value of 4th minus this much of amount. So this value comes as a 4,81,950. This is asking quantity. So we use here in this example we use all the tables, first table, second table and third tables, which are given in this modified accelerated recovery system. So according to given table, we just consider that percentage value for calculation of depreciation. Again, we consider that life, it is life and it is life. Accordingly, we find out that class number for that particular property, class number for that particular property. And again from third table, how much year we should, for which year, useful year we should go through for calculation of depreciation, we can find out from this third table. So this is the example based on the modified accelerated cost recovery system. So for the next example is this, again based on this modified accelerated cost recovery system. So here one company ABC traded in a used car with a book value of rupees 25,000. The vendor, having accepted the older car as a trade-in, was willing to make a deal and offered to sell the company a new car with an market value of 4 lakh for rupees 3,50,000 in cash. So market value of that car is a 4 lakh, but it is a given to the company in 3,50,000, and previously book value of that particular car is a 25,000. So total amount is a 3,75,000. Total amount is a considered as a 3,75,000. So they asked what GDS property class the new car would fit into, and how much depreciation can be deducted each year based on this class life. So car belong to automobile class life second year. So if you go to the first table, automobile, this automobile and taxis are that comes under the class life 2 year. ADS class life is a 2 year, GDS class life 5 year, and class code is a 00.22. So class life is 00.22. GDS recovery period is a 5 year. The ADS life is a 2 year. So cost basis is given as a considered as a 3,75,000. So it gives to the company at value 350,000, but previously its basic value is 25,000. So addition of both these, we consider for the cost basis. 3,75,000, and which is the sum of 3,50,000 and 25,000. And now with this we consider from again for the second table. This we consider again from the second table. From second table for 5 year property. These are the percentage. These are the percentage for calculation of the depreciation. 20%, 32%, 19%, 11%, and 5.76%. These are considered here for calculation of depreciation, and these are the depreciation values. So this example is like this. So which class is this fit? Is this class, and how much depreciation value deducted each year? These are the depreciation values deducted for each year. First year this is 75,000, second year 1,20,000, third year 72,000, like that. So these examples based on these three tables, that we go through these three tables, first, second, and third. From this table we consider that depreciation percentage and calculate the depreciation value. So these examples are based on these three tables. So these comes under the modified accelerated cost recovery system. Now again this is the ninth example. This is also based on such table. This is very similar to previous example. Only you have to find accordingly whatever that given quantity GDS this asset is comes under this class having GDS recovery period of 7 years. So for 7 years again that percentage value for calculation of depreciation is this 0.14, 0.24. Again from second table we consider this and we can find out the depreciation value for this particular property.